What is up, everybody? Logan here, coming at you guys with another video. And today I'm joined with Halcyon Trader. He's been on the channel for the last few years. If you guys have been watching the option strategies, we'd have him on for a lot of calendar spreads and long condor setups we were doing for a while. He's also helped out with the small account challenge, and he's doing a lot of cool stuff as of lately with futures trading. So we're gonna go into some multi-DTE setups for a lot of people who like swing trading. I know I'm very day trading focused as of recent, but the market's actually starting to present more swing trade opportunities. The VIX is lowering, right? The premium kind of sucks in the mornings for these zero DTEs. So more setups for longer term stuff. I appreciate you coming back on for this one, Halcyon, and I'm excited to see what you got for us.
No problem. All right, I'm out. See ya. No, just kidding. All right. Let's as we've talked over the years and unpack different strategies, I think one of the things that has really come to the forefront here over the last year and a couple of months, specifically during our bear market, is the fact that different strategies have certain types of environments where they work amazing in, and then they have certain environments where they're terrible in. In fact, I think that's the case for basically every strategy. And unfortunately, what happens is, you have somebody who finds something that works pretty well in a specific style, say, for example, a one-way market as in late 2020, 2021, and then all of a sudden it stops working and they're left scratching their head of like, what's going on here? What am I missing? What pieces changed here that my doing put credit spreads every single day are no longer working. I'm getting blown out on the bottom end and there's no end in sight in this. So I think as a trader, our job is, well, first to make money. Second is to be constantly adapting, and know that you don't know everything. And the market is going to, at some point, shift its characteristics, its personality, and your job is to make sure you have the tools to take advantage of that. So, zero DTE has been on fire for the last 16 months or so. Really turned up the heat once it all became available daily. I think that was back in March, April, May of last year, somewhere around there. And we've seen obviously a huge jump in that. It's made the markets in general be a little more difficult, a little more different to interpret, as a lot of the typical data that's derived from SPX options looks a little wonky, like the VIX, like the put call ratio, things of that nature don't feel like they're accurate right now. And so as a lot of people have honed in and got pretty good at understanding how to trade those, and there's lots of different ways you can do momentum based, you can do odds based, there's different ways to do it. But also at the same time, when we look at zero DTE, eventually there's going to be a period of time where that's not the right place to be, we're allocating everything into that is just not going to be the most profitable way to move forward for what your style of doing is, or your trading is. And I think it was, you and I talked about this on maybe a day or two ago, where we're discussing, like, when the next shift happens and it tends to be more multi-DTE in nature, or maybe it's more directional natured, let's make sure we're ready to take advantage of that. So I want to just walk through and discuss a very simple means and methods that's mostly odds based, but has some elements of momentum in it. And I guess maybe we should define really quickly what the difference between those two is. So momentum based trading is going to be, you see price move in a particular direction and you get in line to go with that direction, right? That's at a very simplistic way of viewing momentum. That's what you're trying to do as a momentum trader. You want to get into the trend, whatever time frame you're looking at on your trend, and then ride with it. Where odds-based trading is going to end up being less about riding momentum and more about the threshold by which the market moves around. So if you get too far extended one direction, you jumping in to participate with that late in that move is completely insane, unless you're going against the direction. And then that, to me, mathematically makes sense. Odds based makes sense. So want to talk through basically a kind of a mismatch of both of that style of trading for doing multi-DTE style of trading, and walking through just some of the mechanics of how that works. So if that's something you're interested in doing your own deep diving on, looking to see what you find in your own charts, This is maybe the start of a conversation for yourself to see how you might take advantage of this. Okay. So one thing on this, well, let's go with setup one. I'm gonna grab SPX, pull this back up here, and let's change this quick. Oh, get out of here. 1 second. There we go. Need to get my drawing set. And let's change that to some moving averages. Okay. So here is for April, May, and the end of the quarter. Here's what we're looking at as the expected moves for April, May, and end of quarter. Right. So from a perspective of looking at this via probabilities, essentially from this last bar that opened up that ended March, and then right down the middle here is basically if the market does nothing, it's going to stay right down the middle. Now we have these sloped lines that are telling us the trajectory by which this will stay going towards the expected move. Right here's the beginning of, or the end of April, so it's right here. If the market just hugged its expected move for this month, it would stay on this slope all the way down until it got to here, and that's targeting 39.44. Okay, just so everyone who's watched this, who's not familiar with this, you understand what you're looking at here. Same thing on the upside, right? If it went to the upside, just expected to move all the way up the whole time and just perfectly hug that, boom, you'd be eventually at 42.75. And then the same thing for looking at the other expirations. So here's where May would expire, 43.74. And then if we went further out, all the way to the end is at 44.55 for the end of the quarter. So one way to look at, and so I do this every single quarter. I just want to put these under so I have a good idea where my quote unquote playing field is. Now, this doesn't mean that it's impossible to blow out the expected move on either end. We know this in an intraday perspective. This happens actually quite regularly. On a daily perspective, though, it's less frequently do we see this take place. Most often that's happening in really, really aggressive early bull markets or very, very aggressive early bear markets. When you get to a market like we're in right now, which is a late stage bear duration market, you tend to see it like kind of calm down for a bit here. As we've seen in the last couple of weeks, it's, we're not moving a ton. We're not seeing the 2% days every other day, right? So one of the ways to set this up is and you're looking for obviously multiple triggers for what are opportunities and multiple ways to get yourself prepared to take a multi-DTE. One of those ways is get extended in a short period of time, right? So we can see end of April's right here, right? Here's end of April. This is that time frame right here. And if I'm getting way down in this range, like middle of the month, what would be a logical thing for me to want to consider doing? For me personally, is I want to look at selling into that premium, right? So if we get this thing to roll down in here, let me just get a little annotation tool. It'd be easier to see it that way. So if we get this thing, it squiggles and squiggles and rolls itself down into here, right? And we got a bar sitting here, and we got all this time to go to the end of the month. You better believe that a couple things are happening. One, premium is real juicy here for selling anything underneath this area. Two, I now know that from an expected move perspective that was built into this thing, it makes way more sense to have at least some kind of regression back up and then falling back down again. And I want to take advantage of this, right? When we get extended either direction, you want to look at doing the opposite of what the crowd's doing at that point. So I want to look at, can I sell some premium down here? Can I find a place that I can sell some premium at to take advantage of this natural reversion back up a bit before it continues this resumption? Because no market just goes one direction. I don't care how bearish or bullish you are. It doesn't just continue marching one direction indefinitely. And in fact, if you start paying attention to that and look at statistically how often that happens, you can you have a really good idea and put some odds extra in your favor. So for example, right now the market has been moving in about 3 to 5 day bursts one direction. Logan, you and I talk about that, I would say pretty often, where we are on the count with all this stuff. And when you get extended beyond that 5, 6, 7 days in one direction, you almost always are going to have your pullback take place, right? So if I'm going to pull the futures up here real quick just to emphasize that point. TOS randomly gives down days as up days and up days as down days for some reason on SPX. I don't know why that is, but I've seen it happen a lot lately. Anyway, so if we look at our futures, right, and let's just do just a quick couple counts, right? So here we go. 1, 2, 3, pullback day. 1, 2, 3, 4, pullback day. We're at 1, 2. So what would we expect here? Probably a third or maybe a fourth day up, then a pullback day, right? And so you pay attention to your count on 1, 2, 3 down. Technically, this actually is an up day. I don't know why it's considered a down day here, but either way, you pay attention to where you are in this 3 to 5 day cycle. And what you try to do is time your multi-DTE entries when you have a push one direction. Now, to keep adding odds into your favor, right? Go back to our SPX. Let's say we've been having this kind of slow, steady drift take place. And we've had, slow, steady, we keep drifting down. And then we get like a 3 or 4 day straight that pushes well below where the slope is supposed to be. That's an awesome opportunity to set up some kind of multi-DTE particular phase. Now, the question always comes into how many days should you do it and what's most optimal, and what is my most probability of success in terms of length of time. And so for me, that is answered by two questions. One, what is the broad market currently doing in terms of, is it in a bullish uptrend that's having a small reversal happening, or is it in a bearish market being pulled down and this is just a small bump up, or whatever the case might be. But knowing the context of what you're currently investing in makes a huge difference of whether or not you want to be on the put side or the call side of this, especially selling premium, right? So for me, I have pegged out right now that the SPX should maintain its bullish vibe into late April. That's what my projections are showing. And so what I'm looking at is any of the normal pullbacks we see take place, that we're going to likely hold or maintain, or at least our 10 or our 20-day moving average, most likely. And on top of that, we're going to hold, if we were to do an anchored VWAP on this thing, you're likely to hold that as well. That'll be another awesome area of support, anchoring it from wherever your low of the rally started, right? So that's a little pro tip there. Put your anchored VWAPs down. Makes you, it gives you a pretty good sense of where are you going to see a lot of buyers coming in most likely. Again, take responsibility for your own trading and, build your tool bag here and make sure you are setting the odds in your favor as best you can. But for me, if we drift down here and we get to around this 10 to 20 day moving average, I think it's 10, this is 20, specifically get down to 20, and it happens on 3-ish days, 4 days of red to get there. I don't care if they're small days or big days, but whatever. I'm always going to look at taking about a week, anywhere from 3 to 5 days out DTE. Now, why wouldn't I just do the next day? You totally can do that. I just personally, for my style, I like to have some room to work with that I need to. Now, this is also the thought here is that when we enter into those, there's a good chance that if you get in there around 3 or 4 or 5 days one direction, there's a good chance the next day is going to be either sideways or the opposite of what you got into, which of course that is like a super magnet to pull premium out. And we've done a few of these where we've put on 30-day DTEs and collected 80% in the very next day. And again, so if you take logically think somebody who's throwing on a 30 DTE trade, you'd think it would take you 20 days to collect 80% of it, yeah. Right? But when you put the odds in your favor by knowing where you are on the playing field, right? Know where you are on the playing field and know where you are in the count, it's like a superpower, knowing of keeping yourself out of harm's way. Now, what most people do, and let's talk about what the dumb things that most people do, is they do the opposite here, right? They see, oh man, it's getting bullish. Oh baby, oh look at this candle, it's expanding up. It's rocket ship here we go. And then they look to add put credit spreads on like day 3 or 4 of an uptrend, right? Yep. Which is just, you're just asking to get run over. Like, I mean, I want to say, Logan, you called this, you perfectly timed 2 back-to-back call credit spreads during this period of time right here. When you had a nice 4-day run, I mean, it was almost 5-day run here, but nice 4 days straight up. And it was this very obviously, okay, this is one of those times where it makes no sense to be putting a put credit spread on here. It makes all the sense to be playing the opposite side of this because you've stretched so far from the mean. The likelihood of continuing to push above that is small. especially because we are in a duration bear market. That is, in the way duration bear markets act is you have periods of, these small bull runs that last a month to 2 months, followed by another, 6 to 8 to 10 weeks of hard selling, and then another month or two of, take some of that pressure off, and then repeat. So again, this is what most people do, is they let the FOMO drive them into putting on a spread here, and then they get themselves stuck in these goofy positions where they've taken trades that make no sense, right? We've all done it. It's not to say that I haven't done this before either, because we've all done it before. And that FOMO monster, man, when it sits on your shoulder and is telling you it's going to the moon and you're missing out, some of the dumbest trades we ever do are because of that specific issue. So don't do that again. Now that you know to pay attention to that 3 to 5 day count, don't ever find yourself putting on a position 4 or 5 days into one-way direction that is supposed to go with that. It doesn't matter if talking indexes or stocks by themselves. If you do any kind of, deep dive digging into how they move and how they act, they don't stretch much more than 3 to 5 days. I personally literally track it on a separate Excel sheet, and I pay attention to how many times in a row have we hit that. And only once all of last year did we hit anything longer than 5 days. So we actually had 11 days, technically was the longest stretch in early 2022. Actually, it was mid part of 2022. So that's the first part, right? So you can set up a roughly week long. Again, for me personally, I like to give myself just a little more room, but I also know that, if you get it correctly in the odd side of things, if as long as it goes one way the other direction, you're collecting almost all of that premium. It's not like it's going to take 20 cents out of it and you're sitting there waiting to collect your extra 80 to 90 cents on it. So that's one main thing. Okay, that's one way to do a multi-DTE. The other way to pay attention, this is looking at the 65-minute bars, which just gives you 6 equal bars per day. That's what this middle chart is. Let's zoom into him. All right, so here it is.
Something I was going to say too, really quickly, about like the statistics of how many days in a row you have something. I think there's less than a 1% chance that you have 9 days in a row going in one direction. So even if you're 4 days into something and you start to feel FOMO, you should expect a red day to get in if you think it's going to continue to go that direction that you're feeling the FOMO for. So,
for sure.
So yeah.
And FOMO Monster tells you all kinds of dumb stuff. It's incredible. So on the hourly chart, right? Like, especially if you're looking at multi-DTE stuff, you should not be paying attention to the 5 and 15-minute chart. That makes no sense. That's not going to help you with entries on multiple day holds. You should be looking at, hourly, probably at the shortest, and then looking at your, maybe half days and full day bars to see where you want to look for entries. Obviously, more things you can consider. I know, Logan, you've done some videos and discussed this before, but pay attention to where your main support resistance levels are. I think this past year has been a reminder for me personally of being really, really closely zoomed into where exactly those are, because the market has respected those a lot this year. I mean, when you get a good idea and you know where they are, which for me, I use Adam Mancini stuff, but when you know really clearly where those levels are, especially the major key ones, it's another layer of just adding in some odds in your favor to make sure that you're not taking stupid trades, like blindly walking into dumb trades because you don't have the full scope of the information. So when it comes to the 65-minute chart, this is what mine mostly looks like. This is the Heikin-Ashi candles, right? Because I'm not trading this intraday, looking to swing a market 1 to 3% or something. I care more about what is the trend doing here, right? Because I want to, again, tilt my brain into giving me the best odds possible versus getting caught up in the intraday noise that shows up when we're talking zero DTE world. So one of the things to look at here, which I'm going to turn these studies back on, is let's put these back here, right? So let's put this study back on and layer one piece of information in. Okay, Logan, my favorite standard deviation channels. You and I both use these for forever now at this point. So this is just looking at in this particular time frame what has been a very, very tried and true and pretty well respected ranges is the 1.25 standard deviation channels for the 65 minutes. They pretty well stay within these channels more often than not. So of course, what do I mentally look for? When do I get down into the lower end of the channel? And should I be, selling call credit spreads here, or should I be looking at where are my setups for put credit spreads? Because we've stretched mathematically far enough away where the odds are probably pretty good at this point where we're going to go the other direction. And the same exact thing implies here is that, when you push all the way down to the lower channels and you do it in 3 or 4 straight trading days to do that, this should be screaming alarm bells of look to take the opposite side on this, because the likelihood it continues rocketing down is very, very, very small, right? Very small. And that it's a really good opportunity that you're going to see at least a sideways day or a minor bounce day. And if you get your multi-DTE, say you get a 3-day multi-DTE on that, that's the moment you have that sideways bounce, all that premium just gets sucked out because the market's pricing in, it's going to keep pushing lower. And as soon as that doesn't happen, boom, it's there's you're collecting 80 to 90% and you're out. So this is one layer that I like to throw on here. And the second piece I like to see to help this continue to smooth this out is adding Keltner channels onto this. So let's throw these on here. And now let's look at this extra piece of information we have that's playing in concert with these standard deviation channels, right? I do a lot of my shorter MDTEs are based off of this chart alone. This is all that I have on here. I don't look at anything else. And so what I'm watching is in our Keltner channels, when we have this two things happen where our top band of the Keltner passes the top band of the standard deviation and the price pushes over the top of the Keltner channels, for me, that is a trade that's getting ready to be set up. And so all I'm looking for is whenever this pressure finishes to the upside and starts going sideways, and then I see the first red bar that closes back inside of the Keltner channel, that is for me a trigger to add on anywhere from 3 to 5 day DTE trade, right? And what I'm looking for typically on that, if I believe I'm in a bear market in terms of that we have downward pressure going on, that we've expired out the most recent rally of the bull side of things, and I'm expecting, a couple of weeks, I will then do a longer duration one. I'll look at more probably 21 days upwards to 30 at max. I don't usually go much past 30. And I'll do closer, like delta 20s or delta 25s on those, because I believe that I've got the right ingredient mix that I'm going to be correct on this. So on the saying it doesn't matter if it's call or put side. I will say it's easier on the put side to do this versus the call side. But anyway, so this is a trigger right here, right? And then the same thing once you finally fall back through. The characteristic of the way the Keltner works is it wants to be, it's the magnet is the midway point here. So it wants to be pulled back to this, hug it, and then once it goes back and touches the lower end of the channel, it wants to again go back to the midpoint. So it doesn't want to get stretched too far away either direction. That's just how obviously mean reversion works. Now the same setup, the next trigger is when you go, the lower band of the Keltner channel goes below the lower standard deviation channel. You have that exact same setup happening again. And all I'm looking for then is a green candle closing back inside the Keltner channel. Once it's done that, again, this is a Higanashi one. This is not a standard candle. Once that happens, then that's what I'm looking for to add on a multi-DTE put credit spread. Now, there's some other ways to help layer this in to make it a little bit simpler. And this is more advanced stuff that I don't think we're going to get into on this particular video, but it's discussing how to tell how long the market should rally, which is if you can get that knowledge and ahead of time, obviously you can be extremely aggressive either way. But we'll unpack that on another one on how to actually tell that. So, and this is our last main put credit spread setup that I saw that was a super obvious one, was right here when this took place. And you could have done a couple of them, which I know, Logan, actually you were doing this. You probably did 5 or 6 or 7, I think 1 DTEs in a row of put credit spreads.
It was literally every day I was like, wow, we have all our levels below us. The market continues to show bullish like sentiment between the advanced decline rising every single day, and how much we had sold off with the bank news, and then the banks end up getting bailed out. So I found myself to be quickly on the right side of the trade and collected like 20% on that first put credit spread. And I had like 70 or 80 points of runway.
Oh
And
yeah.
it was really cool
Yeah.
because the next day was green and literally all that premium got sucked out. So yeah, I remember
Yeah.
the first trade the most because it was definitely the best return. And it was literally like if you talk to anybody emotionally, that was probably the scariest time to put one on for anybody taking a position that didn't have a thesis for why to get bullish there. But for me, it was like the bread and butter time to do it. And if you're wrong, you're wrong. But at least you know that when you took that shot, you had better odds of success than any other time before then. So
Yeah. I agree. Um, yeah, totally agree. So you, as it relates to just looking at this top chart, again, you can do some additional things. I try not to get too many technical indicators going on these things. I think it eventually gets too much, you have too much analysis going on and you end up, paralyzing yourself waiting for 47 different indicators to all line up for you.
yeah,
But other ways to look at additional entries and or additional confirmation for yourself is, again, this one's the easy one to me, is when you get to the lower end of the channels. Again, this is pure contrarian, right? I mean, but the reality is the reward, there is no real reward unless you have some kind of meaningful risk on there. And until you get that meaningful risk going, you're just picking up pennies in along the way. But you can also see squeezes, right? You see some squeezes showing up. This is a bullish squeeze showing up. And then for me, I use RSI just as it over or under 50. So if we start seeing it pushing over 50, and you can see it obviously trending up, that's another reminder of, yep, the market's want to shift bullish here. And then your MACD, right? If your MACD's, angling up, I don't really care about the crossover when that happens, but just the general side of the trend. And when that's angling up, again, more pressure on, at your back, pushing the market that direction. So now now that we just talked this through, what is the next setup we're looking at? Right. My next one is I'd love to see the market push it back up above this 41.53 range. Who knows if it'll exactly be at that level when we get to that. But that would be awesome to push back above here, have the Keltner go back above that. And then we just literally rinse and repeat the trade. Right. So oftentimes what you'll see is that if you throw on some Keltner channels on here, and just for everybody who's curious, this is my actual setup on there. It's 4.25 factor with 55 length. Okay. And then I also, I don't like seeing all the lines killing me on this thing. So I changed the transparency to be quite a bit, more transparent than otherwise. Otherwise, I feel like it's just too much line popping out at my face here.
yeah,
Yeah, so you can also see, if you start paying attention close to this, there's lots of times where the market runs up to the top of the channels and then pulls back. So again, looking for entries on 1 or 2 day DTEs, these are also ways to do that too. More often than not, if you can tie these in with being at 3 to 4 days in on the count one direction, that's a really, really high probability trade. And it's a good 1 to 3 day type of hold. Obviously, the further you go out and look at some bigger time frames, you can do the exact same thing. So if you use some bigger time frames, you can do some longer setups there. So let's say you get 3, 4, 5 days, and you're at the top of the end of those calendar channels. You better believe I'm looking at 15, 20, 30-ish days out, and then getting a lot more premium by going closer to the money, because I believe I'm going to be correct on it playing itself out. So there you go, man. Keep it short and simple here. Don't have it too much data. So do your own due diligence on this. Dig in. 1.25 standard deviation on the 65-minute charts. Keltner channels 4.25 and 55, and just look at that. See what it's showing you. Go back and back test it. Look how far back you want to look on this thing. I will say one quick thing. I know where this video is going to wrap in a second here, but one quick thing with standard deviation channels. Reminder, if you were to have gone back, right now it's just telling what it is for this period of time, this 90-day period of time, this is what it's showing. But if you went back and said, well, what would it have looked like up here on, whatever this is, February 2nd, would it look like this? If you go back and actually do the think back at February 2nd, these channels are not going to look like this, because they're going to take the 90 days back from this point, right? So I think sometimes you get this slight misconception that these standard deviation channels always show you exactly where the tops and bottoms are, because sometimes what happens is like where this area is, this might be like literally in the middle part of the channel, not actually at this low part of the channel at this point in time. So hindsight reviewing it is not always the most accurate. So I would recommend, if you've not used standard deviation channels before, go do that. Go look on the think back on a date you want to see, if it really was way over the channels. and see what you see on there. So there you go, Logan.
Awesome. Well, I appreciate you coming back on for another video. I really appreciate all your help in the YouTube community and the Discord as well. If you guys would like to come trade with us down in the Discord, or the link is down in the description for the Discord. If you guys have yet to leave a like on this video, do it now, a comment and subscribe, and I'd really appreciate it. And we're going to have Halcyon back in the future. But yeah, I really appreciate you coming on for this video.
No problem, homie.
Awesome. Well, that's going to be everything for us, and we will see you guys in the next video.